Okay. We're going to start part two. The meat and potatoes. Value, cap rates, underwriting, and due diligence. This is where I repeat the disclaimer. This presentation is for educational purposes only. Please consult with an accountant and/or attorney for any legal or tax advice. All materials, content, and forms contained in this presentation are of intellectual property of Eastern Union Funding and may not be copied, reproduced, distributed, or displayed without Eastern Union's express written permission. Section 2, page 3. Key aspects to look at when analyzing a deal. The first thing that's most important is how big of a return we'd like to see. And the reason why that's the most important part is because it's irrelevant where the deal is, what the deal is, how big the deal is, how small the deal is. You have money, and we decided, you made a decision to invest in real estate. Whether it's your money, family money, friends' money, and investor money. Everybody decides they have money, what do they want to do with their money? They could put the money in the bank. If they're not putting it in the bank, what are they investing in it? And what return do they need? So if somebody needs 10% return on their money, and you have a deal that seems amazing, but that deal is only throwing out 9%, it's irrelevant. You don't have the money to buy the building. So I tell a lot of people, as a commercial mortgage broker, and the way the current environment is, I only get paid when I bring a commitment/close a deal. I don't get paid any money up front. Any of you that are calling clients and working in Eastern, you call up a client and you say, give me a shot for free. I'll look at your deal, I'll spend my time, I'll analyze it, I'll work it. And if you move forward with me and we go to get a commitment to go to the closing, that's when the fees start to come to be earned and paid. However, I'm spending all this time for nothing. The time getting on the phone, sending someone to underwrite the deal, sending it out to the bank, I'm having to go meet you, driving, all those expenses we have, and how do I make back my money? Only if I get a commitment/close. So therefore, I'm trained in the art of don't waste my time. A lawyer, on the other hand, gets paid. A guy goes, I have this question. In the middle of answering the question, they get it done. They say like this. They say this joke that this doctor goes, sees a lawyer by a wedding and goes over to the lawyer and says, do me a favor. Wherever I go, people come, oh, you're a doctor? I have a medical question. What do you do? How do you get people to stop bothering you? Free. He goes, it's very simple. I answer the question. And the next day, when you get to the office, send them a bill. Great idea. Thank you so much. Next day, the doctor gets a bill from the lawyer. So they get paid for the time that they spend working. They get paid for every minute that they work. Because of that, we're trained and they work differently, right? I'll tell someone it's not worth my time. It doesn't make sense. A lawyer, even an honest lawyer, could say, let me research it. No, they don't have anything to lose in that researching. When you're buying real estate, you're in the same boat as I'm in. The only way you make your money is when you close the deal. And you may have fees built in to reimburse you at closing for the money you laid out. At closing, you might actually get an acquisition fee to cover, in general, make some money at the time of the purchase. And going forward, that's when you start making yourself a return. So if you don't get to the closing table, it's the same thing. But the most important thing to close on the deal is enough money to put down the deposit. So before you start anything, establish what is the minimum return that you need. That's the first question you should focus on. The second question you want to focus on is tied into how much you like to see, is how much of the return do you need yearly versus over the life of the investment. Now this is very crucial. Someone has $1 million in the bank. They're retired. They need $100,000 a year to live. They make investments that throw up every year 10%. That's how they live. 10% gives them $100,000 a year. They live off it. What happens if there's an amazing investment? It's going to throw off only now 6%. The building's not fully rented. They put money into the deal. They throw off at 6%. However, over the life of the investment, like year 2, 3, and 4, we'll start throwing off a return of 18% a year. That's a much better deal. You'll average a much higher percent return. The person that's in retirement cannot take that deal because they can't live at $60,000 the first year. And therefore, they can't even buy it. So you need to know what return is needed annually and what return is needed over the life of the loan. As we were saying before, the IRR, internal rate of return, tells you what the average return is over the life of the investment. So someone who's very sophisticated says, listen, I don't need the money to live. So as long as I'm getting a 14% return over the life of the loan. I don't care if the first year is a zero and you balance it out over the next 5, 6 years. I'm totally fine with that. I need it from the beginning. I don't need it from the beginning. Someone's retirement needs it differently. So before you go out and buy real estate, you have to know you're costing you money. And before I'm going to show you later how to analyze real estate and how to value real estate and all those things. That's all irrelevant if it doesn't make the return. So you could have a building for sale for $1 million, really worth $1.2 million. But if it doesn't throw off the return you need, it's worthless. And that's why this point is the most important point to the whole entire part of value. Before you even start, you have enough money to go. Don't waste your time. With that, there's a cash on cash return, which is very simple. Cash on cash is, it's not. There's no part of the real estate business that's literally cash. The cash on cash is using the metaphor, using cash as an example. But obviously it's through check and wire and bank statements. But cash on cash returns literally means I put cash in. I wrote a check to invest $1 million into this deal. How much cash, what check did I take out? So if most people care about when they do a deal, what is my cash on cash return? How much am I going to be making yearly, every single year on my money? And the second thing is then there's over the life of the investment, the return. But that cash on cash is usually the most important thing which comes out first. Because if there are some people who might say, listen, I need a 12% return over the life of the investment. I'm fine with the 12%. 12% works for me. However, I need year one, I must have 6. I must have a certain percent of it. Why? Because there are certain people who actually use their lines of credit to make investments. A guy could have money in the stock market. A guy could have money on a home equity loan of a house. He actually makes his investment from. He says, I'm willing to draw off a line. My line costs me 5%. So as long as I'm getting 5% a year, I'm fine to wait for the difference. But I must make 5. And other people come to the table, and other people come out to the table, and they say, I can't go through a 5%. I can't go through a 5% return. It doesn't work for me. I must end up with an 8, a 10, a 12, using the retirement numbers. Now, on the next line, here's something which changed a little bit from when I put this together, and now that we're living in technology with the app. There's a very big debate in the world, how should education in schools work? We need the same education that we went through as kids. Is that the education that kids need today? You can say, let's wait, we woke up to a digital world. The fact of the matter is we have calculators. The fact of the matter is we have Google. The fact of the matter is everyone has smartphones. So to what extent do you have to know all the same things that you have to know in school to go through? Like I say, math, the most you have to know is to figure out a math is to be able to score a bowling game. Because what happens if you go bowling and the computer breaks? Can you play? Otherwise, you have a calculator for everything else under the sun. So what do you need it for? The same exact token over here. Talk about the app. We spent a lot of money building out the app with calculators. We have calculators for cap rates, cash on cash, IRR. So in the past, you had to learn how to do a lot of things. It became much easier to get it done. But to a certain extent, you don't have to know it the same way. My personal advice to you is, if you are by nature a numbers guy, if you are by nature someone that's into details, then perfect yourself by details to try to understand as much as you can without the calculator. Just for yourself, understand how it works. But if you're the wheel dealer of the deal, or you're not involved in the numbers, just know how to use the app to get the same results that have to be gotten. Don't try to polish things that are not your strength. So for today, a cap rate, I'm going to go off on a little bit of a tangent here on the cap rate because the most important part of commercial real estate values real estate through a capitalization rate. What a cap rate means, to bring it down very simple, is as follows. Capital is the money that you put into a deal. I buy a building for $1 million, and I could either put in equity. I get a loan for debt as a mortgage, or I put in my own capital. I write a check myself. That's the capital. It's the equity I put into the deal. The capitalization rate is what would happen if I bought the building for all cash? What is my return? So this way, to compare apples to apples, the fact that I get a mortgage at 3%, my friend get a mortgage at 3.5%, another person get a 4%. That shouldn't determine how much the building is worth. That might show what his return is going to be. It's cash on cash because it has higher payments, lower payments. But if you want to value something, you have to be on an even footing with everybody else. So the even footing on everyone else is, what is the NOI, the profit of the building, and net operating income of the building, and what is the value? So, but people, I'm going to say it in a lot of different ways, and as we go through the rest of the course, you'll hear it in different ways. What's really relevant for you to know is you to know one thing. If you want to figure out a value of a piece of real estate and you don't know what cap rates are and how they work and it's complicated, it's very simple. Have one guru that you trust in every market you're buying real estate in, and you have a lot of those people, and ask them, what are the cap rates in this area? And all you do is you take the NOI divided by the cap rate, will tell you the value. Or in the case here, if you take the NOI divided by the value, will tell you what the cap rate is. But usually, here's how it works. Usually you have a deal. Your starting point about a deal is, what you're starting with is, I have a building. You get the numbers on the building. So it tells you the income, it tells you the expenses, and it tells you the NOI is the net operating income. You take the income. So if a building is collecting $200,000 a year in income, and the expenses on this building with everything in underwriting is $120,000, the NOI of this building is $80,000. That's a fact. 200,000 minus 120. So I have $80,000 left. That's my NOI. What is this building worth? The only way to find out what this building is worth is ask an appraiser what cap rate is used. Meaning, if someone were to buy this building all cash in this neighborhood, how much would they pay for this building? What return would they need? So you, in a better neighborhood, in a better property, you're willing to make less. In a worse neighborhood, in a worse property, you want to make more. That's just the reality of what goes on. So based on that, in a beautiful neighborhood today, properties might sell at a 5 cap or a 4 cap. The lingo means that if someone was buying a building in this neighborhood, they would be willing to make as low as just a 4% return on their money. And in other neighborhoods, if I'm buying this property, I better be making 8, 9, 10%, or 12% on my money, the cap rate. Today, I would say that 99% of all cap rates today float somewhere between a 4 cap and an 8, 9 cap. Almost everything floats in that range. That's the whole entire range where it floats at. And if you leave the prime neighborhoods like New York City, prime New York City, it probably jumps up to about a 5.5, 6. Like it doesn't make sense. Those 4% numbers makes no sense to buy it. But those are people buying real estate because they're saying my money is literally sitting in the bank. The building I'm gonna keep for my great grandchildren. So I'm not doing anything with my money anyway, so I'll buy it at a 4 cap. Makes no sense. But in order to really make money on an investment, you have to probably buy it at a 6 cap or higher in today's interest rate environment for it to start working. So a cap rate tells you how little or how much would a person want to make on the money. What gets people confusing is that because it works in the inverse way for value. The lower the cap rate, the higher the value, which would make sense if I repeat it again slowly, how I said it before. This is such a nice neighborhood, so I'm willing to only make 4% on my money. This is a terrible neighborhood. I must make at least 8%, which would mean that if I had a building that threw off $80,000 in a bad neighborhood, I'd pay $1 million for it, an 8 cap. Because $1 million times 8% will throw me off 8% is $80,000. However, that same exact building, the same NOI, was based in prime New York City, I'd be willing to only make a 4% cap. I'd be able to make 4% of my money. So I'm willing to make so little on my money. And therefore, how much would I pay for that building? $2 million. Because if I pay $2 million, I would be able to go ahead and get back 4% of $2 million is that $80,000. So it could get sounding all confusing to you and throw you off. What's really relevant for you to know is a very simple thing. When it's relevant how you ever practically apply this, when it's your responsibility to figure things out, you're not going to become an appraiser, is when you look at a building, get the NOI, get the net operating income of a building, and ask people in that area what the buildings trade at, what cap rates, and just divide it. Oh, cap rates in this neighborhood are 7.25, so take $80,000 divided by 7.25%. It'll tell you the value. That's what you have to know. How do they actually get the cap rate? The cap rate's factual. They look at the last 5 buildings that sold similar in that area, and they say, what was the sale price? What is the cap rate? What was the sale price? And what was the NOI? And they go through it. They look at a building and say, this building just sold at $80,000 NOI, and it sold for $1 million. NOI, $80,000, the formula on the page, divided by the $1 million equals an 8% cap rate. The building next door sold at $85,000 of income, of NOI, and it also sold for $1 million. So that sold at 8.5 cap. So this neighborhood right now, both buildings were identical. You would say this building, the neighborhood, is roughly an 8.25 cap, somewhere right in the middle. That's the practical sense. This is the most confusing part of the whole entire commercial part of real estate. And people think they have to know much more than it. All you have to know, what I tell everyone is find the guru you trust, ask them what the cap rate is, and just apply the cap rate. Regarding the app, has all these formulas built in. So you know the cap rate, you can tell you the value. You know all these things, it'll tell you within the calculator section, it will tell you all there from there. So as we go through it, I'll show you the practical applications to it. What a cap rate means, what's relevant to you to define it is, it's assuming I bought a building for all cash, what is my rate of return? What is the capital rate of return that I'm getting on my money? Assume I bought it all for cash. And then by taking a mortgage, I'll show you later on, that's you leverage up your investment to make a higher return. Due diligence and comparison appraisals are needed to confirm your assumptions. When you get a deal to look at, so the first thing you look at is you trust in the guy's numbers. He tells you as a building, it's throwing off $70,000, $72,000 in income. You look and see, if I bought the building, you have all your gurus and your assumptions that you make. When your person you deal with tells you, assume this loan to value, assume this interest rate, and you use the calculator again, it's all the calculators, so then it figures out that this building has a cash and cash calculator. It'll tell you what's your purchase price, how much of a mortgage you're taking, how much you're putting down. I'll figure out what your cash and cash return is. If the cash and cash return works for you, that's the first thing you do. You want to make sure how much is your return you're looking for. If you need a 10% cash and cash return, how do you get there? You go into the calculator, you'll type in, I'm buying the building for $1 million. My NOI is this. My down payment is this. These are my closing costs. All these expenses will come in and calculate for you. The cash and cash return is 9. If it's 9, don't go forward. Don't waste your time. So many people say, let me just check, maybe I'll find something. Let me tell you the history of the business. Never in my history. You know, they say never say never. In this case, I'm going to break the never and say never and say the never. Never in the history has a deal come into the shop. Have I seen a building for sale that had an NOI, the profit of the building, as told to me by the seller? And after I did all my research and due diligence, I found that he made a mistake, and really there was more profit. Never happened. It's the opposite. So therefore, the minute you look at a deal and it doesn't give you the cash on cash that you're looking for, or the IRR that you're looking for, the minute it doesn't, it's over, move to the next deal. It's only going to get worse as you go down the line. So don't waste your time. And so many people waste their time. And you're in the same boat as I'm at if you're looking to buy real estate. You're spending money and time before you make your money back. And you only make your money back at commitment/closing. So what are you doing? However, once it matches up, then you wear a due diligence hat. And then you compare and check every single line item. And you want to make sure that show me what last year's expenses were versus the year before's expenses. And I want to see copies of bills and copies of invoice. I want to walk through every apartment. I want to spot check, do 1,000,000 checks of due diligence. Why? To see that $72,000 worked at $72,000. What happens after you start doing due diligence? You realize it drops down to $70,000. Does it still work for you? 68. There's a word called a stress test. Okay, it's used a lot of times in banking. When a lender makes a loan, they say the loan works, but I just want to run one assumption. What if in the next 5 years, when your loan matures, interest rates go to 7%, can you still afford to make the payments based on the balance of that time? And they have certain stresses that they do to ensure that what they deem to be normal changes in the market, they're fine. It's a stress test. You can take stress test, people go to the doctor, get a stress test. They want to test the limitations to see how healthy they are in that. The same thing works over here as far as the stress. When you find a deal that works, the first thing you should try to do is, I found this deal, building number 1 works for me at $72,000. Play with the numbers in front of you. How much room do you have for error? If the NOI drops to $68,000, does it still work? So you can lose $4,000. So when you start doing your due diligence, the minute you find $4,000 worth of mistakes, stop right there. Some people make the same mistake. It looks day one, and they spend hours and hours and hours. They couldn't realize halfway through it doesn't work anymore. The same way you keep rerunning the numbers to make sure that it still adds up and starts making sense for you. So in due diligence, you want to be like the work of a detective. Everything question and get an answer. Let the person give you their answer. Don't say for yourself, oh, I probably know the reason why. Even you might probably know, you can in your mind. Like I said, why you took this course. You could assume why I'm giving the course and not giving the course. That's fine to have your assumptions, but still ask the question. And then see if the answer reconciles with how you were thinking before. So you take that due diligence. And then comparison appraisals. So comparison appraisals is that, like I was saying before, ultimately, a building is worth. The value of a building is an opinion. My opinion is that this building I'm in right now is worth $3.5 million. What is my opinion based on? It's based on comparables. That somebody came to me and showed me that the building next door sold. There's nothing better than actual sale. Building sold, that's what it's worth. Someone actually paid cash that price. Short of that, an appraisal is just an opinion of what it should be worth. What does the opinion use in their appraisal? They use comps of recent sales. So the key thing, again, that's we put into the app also. And the difference, understand the data that we put onto the app and data you could buy for a lot of money, is I put on the factual data. If you type in any address in the United States on the app, it will tell you in the last 6 months, every property within a certain mile radius that closed and the purchase price. So now you know facts, what actually closed around you. If you went out to a service and bought data, you could run reports on each individual building, etc., drill it down. But when you're doing your research to buy, I'm providing you the information that a buyer needs just on the surface. I bought a building here. What happened recently in this neighborhood? So then you could get into your car and drive and look at those other buildings and say, if that building sold for $2 million, that building sold for $1.5 million, and this looked like that looked like that, then my building for sure is not worth more than X, or for sure worth more than Y. You can make those decisions based on comparables. So we work as a broker, and a client engages us to work. A lot of times when it comes back, and let's say the value came in short, the borrower was promised a loan of $7.5 million based on a $10 million value, 75% loan to value. And the appraisal comes in short, $9.5 million appraisal. So therefore, they're lending you 75% of 9.5. The first thing that we're doing is checking. The first thing we do is we check what's the bank's NOI, what's our NOI, what's the appraiser's NOI. Because the only way that it's possible to be off on a value is only two numbers, my NOI and the cap rate used. The only way we could be off. So if I had an NOI of 72,000 and the appraiser showed an NOI of 70,000, that's why we're off. He's showing less income, less net income. And we would go literally line by line by line to see the discrepancy and find out why. Because it's a logic-based business. If he came out because he found $2,000 more in expense, then maybe he caught something I didn't catch. And then it becomes a discussion. Many times that discussion is an expense that was in existence for the last few years, and the client says, we're not having it anymore. Why? How do you know you're not having it anymore? So if he could prove it's a one-time expense, then you could prove it. What happens? Taxes. Taxes always go up. So sometimes the biggest reason why an appraisal falls in short is that we looked at a deal, end of the year, and the NOI was 72,000. The appraisal comes back way off. He has 66,000. So where do you get it from? That's what do you mean? They can be raising taxes next year. And you're buying a new building. It's going to show the new assessment is going to be based on your purchase price. And based on your purchase price, based on the assessment, the percent they use for taxes, now you're stuck with an extra $6,000 in expenses. So I agree with everything. I agree it's an 8 cap. I agree with all the numbers you had, but your line item with the tax total. And that's what happens in a lot of deals. Someone misses the due diligence. A bank hires an appraiser to catch it. But assuming, let's say, that the NOI is the same. You had 72,000? I have 72,000, which is usually the case when you're dealing with a reputable firm that you're dealing with. You're dealing with a mortgage brokerage shop, a sales broker, knows the market. Usually the numbers are going to roughly be the same. That's not going to be the issue. The issue could be what cap rate he used. I think he should use a lower cap rate so the building is worth more. To show it's a better neighborhood, it's worth more. But he used the higher cap rate. Said, no, it's not as good as you think. Okay, they have this graphics, this picture, like 4 different illustrations of the same house. And one is a picture how the owner looks at this gorgeous mansion, and one how the banker looks at it this way, and the appraiser, that shows like the same house, everyone's view is a little different. So the most common argument is an argument of, I use a 7 cap, and the appraiser uses a 7.5 cap. That difference is a lot of money in the value. And I said, where do you get it from? He'll show me his comps. He's going to show me. Now, let me show you. Building down the block like this, sold for 7.5 cap. And I think it's a nicer building. So if the building's nicer and sold for 7.5 cap, why should your building go at 7 cap? Your building should be at a 7.5 cap. Now, if I could drive down to that building, I call up the owner who knows his neighborhood. He tells me, yeah. You know why that sold for that price? Because the guy was getting divorced. He had to sell fast. There was a problem. So he said, okay, that means something. That means it's not really a 7.5 cap. It really should have been a 7, sold off. So if you have an argument, it's a logical argument. That alone, that's 7.5 now. Okay, I can understand that. Based on that, it's a little bit of a discount. The next building, you know that what's going on in that building has been crying for who knows how long. Or there's things under the hood. Everyone can't know everything about every building. But usually it's a logic-based argument. But ultimately, it's an opinion call. So the opinion call is, I don't agree with you. I think that this building is in the worst part of town than the other building. I think that someone would rather own a building here than over there. And I think that the fact that the entrance on this side of the street and that side of the street is a difference, and therefore you're not going to be able to win those arguments. Someone has a great relationship with an appraiser, get them to listen to their opinion, they can talk it out. But ultimately, an appraiser is an opinion. There's no facts. There's only one fact. I paid $1 million in this building, and the NOI was $72,000. Fact, I bought this building at a 7.2 cap. That's it. Because I bought it, I paid the price. But if I paid the right price, was it really worth it or not worth it? It's an opinion. Based on the neighborhood, I think I got myself a better building. And that's how it works somewhere. How bank financing leverages the deal to give you a higher rate, a higher return on your dollars. And that's a big part of this leverage. If you buy a deal, I'm going to go through this more in detail, obviously, but if you buy yourself a deal at a 7 cap, that means that a building you bought for $1 million, it's throwing off $70,000. So if you bought it all cash, you made 7% on your money. $1 million in, got $70,000 back out. But if you found a bank, let's go to the extreme, to lend you 100% of the money at 5%, right? Then you're actually able to make an unlimited return because you didn't have to put up any money. The bank gave the $1 million. Forget about closing costs and all that, keeping it around. The bank gave you the $1 million. The bank is asking for 5%. So you're getting 7% from the building, giving away 5. You're left with that 2% in the difference. So now, banks don't give you 100%. Banks give you 75%, let's say, a typical deal. So therefore, in a case like this, 75 on 25% of the deal, on $250,000, I'm making like 7%. But on $750,000, I'm making an extra 2% from 5 to 7 because the bank's taking 5%. That's an extra $15,000. 2% a year on $750,000 is $15,000. $15,000 on my investment's no longer $1 million. I'm going to go through this much more in details, just have to get the concepts here. But my investment is no longer $1 million. I didn't put $1 million into this deal. I only put $250,000 into this deal. If I got $15,000 extra from the other money against my $250,000, it's roughly like 8% is the difference. So I got 7% return because that's what the building was throwing off my $250,000 plus 8%. That same deal now throws off on my investment 15%. That's how leverage works. So someone buys a building at a 7 cap, which means if you bought it all cash, only getting 7% return his money. If he got a great enough financing deal, and he kept all the extra profits, put it against his actual investment, that same deal, he leveraged it up, and his return, instead of getting 7%, he got 15%. Page 4. There is something called, when it comes to businesses, when it comes to accounting by businesses, there's something called GAAP. I think it stands for General Accepted Accounting Principles, which basically means, how do they run a business? How do you have publicly traded companies that you could decide how much a company is worth multiple times its earnings? Maybe one company has a different method in how they allocate expenses. We use the discussion about depreciation. They say that the lifespan of a building is X number of years. The lifespan of a computer is 5 years. Maybe one company decided it's better for them to put all their expenses this year. And one company decided, no, why divide over 5 years? I won't be showing enough profit if I just put a lot of equipment this year. If I can do it over 20 years, then big deal. That looks better for me in my numbers. So when it comes to accounting, it's General Accepted Accounting Principles, which forces any accounting firm that's doing, when it comes, how do you deal with this expense line item? Everyone has to treat it the same. So when I find out that a business they're in the business, it's not called NOI, net operating income. It's called EBITDA, which is the acronym for earnings before interest, taxes, depreciation, and amortization. Debt amortization. I think I'm missing one. But what's the purpose there? This way you know. If someone tells you the EBITDA of this building, of this business, is in 1.1 million, you know that they did it with GAAP built in. You could ask, like, does it have a kosher certificate? Is the kosher certificate GAAP? Did they do it regular GAAP accounting principles? If they did, then you know it has the 1,000,001. So if you found out that a similar business sold at 10 times its profits, that business had $800,000 in EBITDA, I know if this business has $1.1 million, what is it worth? $11 million, 10 times. That's be a common way how people use it. In real estate today, the same concept applies. It's a general accepted way people underwrite deals. And when they finish underwriting a deal, they arrive at what's known as the NOI, the net operating income. The most important thing that you need in any building is what is the NOI. And when you have the NOI that's set up on the property, then you know that's your starting point. It's throwing off 70,000, 75,000. What cap? Everything is built off the NOI, and that's how it's set up from that point on. So therefore, when is it not working? What does it say? So when someone goes out there and says the NOI, that's the most important thing. And this general accepted way that people underwrite a transaction. And therefore, so a lot of times I get a phone call for someone selling a building. I have a building, it's throwing off $100,000. It's throwing off $100,000. The building is worth X number of dollars. That's when the office, but that's the first thing we look at. What are the things that a person typically doesn't put in? Vacancy, management. Right away, your $100,000 is the quickest thing. It gets knocked down. Because if you have an NOI, of $100,000, and you didn't put vacancy or management, everyone puts vacancy. Everyone puts management. But that's what NOI is. NOI says a net operating income. It's all income minus all operating expenses, and using the thresholds of general underwriting to get it done. On page 5, understanding net operating income. It's recording? Okay. Understand net operating income. Income is mostly your monthly rental, but can also include tax and other reimbursements, rental of roof for antenna, parking, miscellaneous income. So in 99% of every single building, the only thing they have as income is what the tenants pay on a monthly basis. When they times that by 12 for a year, and that's the income of the building. There are other cases that have other line items that are possible in the building. So tax and other reimbursement, depending on the property type, sometimes the arrangement, and it's typically not on apartments, these are now typically commercial buildings. Sometimes the landlord can have a deal with the tenant. I'm charging you this rent. Plus, you're going to pay a percent of my certain expenses that I have, either going in, but typically it's going forward, which means the landlord comes in and says, listen, right now, the market rent in this building is $20 a foot. You want to borrow 1,000, you want to rent 2,000 square feet, your rent is $40,000 a year. And the reason why this is the price is because I have my expenses to operate. But I don't know what the future is going to bring. So therefore, we'll do like a net lease. You'll pay me this. But going forward, my expenses, my tax on the building is $22,000 in the building. If next year my taxes go to $25,000, went up $3,000, you're going to pay your pro rata share. You're in half the building, you're going to pay half my increase. So income on this tenant pays $40,000 rent, plus there's an income that they're reimbursing the landlord, whatever the negotiation was. These things typically are on longer term leases on commercial properties. And the reason why they're there is because why, as a tenant, would I want a long-term lease? I want to make sure I don't have to move in the next 20 years. Why should the landlord be stuck with my rent, who's at maybe 2% a year for inflation? And meanwhile, his expenses may skyrocket. He could be losing money one day. So he's protected by, I have to give a percent of reimbursement, and I'm protected the other way around. I know I have my lease in place. The second thing is rental of roof for antenna. So I happen to think that these things are slowly going to disappear. Some people think they're not going to. But again, with technology, if you look at the first cellular networks, you have all those cellular towers. Now, so far they say it's not disappearing, but they typically rent on the highest building in the neighborhood. That's where they put the antenna roof. And they sign, Verizon, AT&T, they all sign for 5-year leases at a time or longer. Now, it seems that with the technology change, it's not that it's going to disappear. The technology change is that the power of the antenna used to work, let's say, for 2,000 feet, or 2,000 miles, or 1,000 miles, whatever the distance was. The better antennas go wider and wider. So when they come out better antennas, it's possible they're going to still need antennas, but not one every 10 buildings, one every 20 buildings. So some banks, and most banks today, do not count antenna route. They don't count it at all. They're not in the business. They don't technology. I know you always have tenants. They're always going to rent over. The reason I'm willing to value the building on this NOI is because of ABC. Antennas totally exempt. There's actually a business that buys, a hedge fund that actually buys your antennas off you. It's like a triple net. They're like a land lease, triple net. They come to you. You have a lease for the next 14 years with Verizon, and they're paying you a year $1,000 a year. You're going to get $14,000 over the next 14 years. I'm going to pay you $8,000 right now. It's a number that they pay. What are they really calculating? That's IRR. The investor who's buying it is actually calculating that if I paid $8,000 up front and I collected over the next 14 years $1,000, what does it work? What is my IRR? Does it make me enough of a return? And here it's no risk. They look at a bona fide lease. To Verizon, the risk is Verizon goes bankrupt. If they believe Verizon's not going bankrupt, then they're covered for the next 14 years and they're going from there. Parking is the same thing. It can be an income, and parking sometimes they do. They give you credit for parking to a certain extent. You know, if you have parking in the building, that's a parking garage in the building that pays you rent, so it's a regular rental. What we're discussing here is the parking because the landlord charges the tenants for spots in the building. They could charge $500 a spot, and that's what they're able to charge. That income, many times they agree to, depending on the building where it is, the situation, but for the most part, you get parking counted at some level. It might get discounted a little bit, potentially, but for the most part, it's counted. Then there's miscellaneous income. They could be laundry in the building. They have a coin-operated laundry in the building. They could have advertising on the building. There's other line items that could be, and it's dependent on certain things. How much does the bank give credit for it, or partial credit for that income? The expenses. These are the main expenses that exist on a building. And I was telling you before in a previous session that there are publications out there provided by appraisers for appraisers that literally have every single line item in every neighborhood, what it's supposed to cost and what it's supposed to be. So you have a range yourself if you wanted to figure it out. Most people practically today buy real estate in the same neighborhood that they're accustomed to, the same property types. So they know I buy in this neighborhood. They have their guru before they become a guru about what it should cost to run and what it should cost to operate. So that some people look at real estate, they don't even go line by line. They ask someone, how many units in the building? 42. They have in their mind what it costs to run a building. Don't tell me. I don't need to see the details. I just know it's going to cost me $3,000 a unit. I don't care what you tell me. It's $5,000 a unit, $4,000. People have different numbers, different classes of buildings, what it costs to run a building. But tax is the biggest expense, obviously, that keeps moving up. It's most unpredictable. Insurance, and this is also pretty straightforward. Property insurance. Utilities, electric, gas, and oil, depending on what the building has. Now, sometimes, again, there's also sometimes people in apartment buildings, they private meter some of these items. So therefore, the tenant has to pay it. So sometimes you have a building where that used to be the plan. It's not so much the plan now new because already other buildings have been converted already if there was the opportunity. But that's where someone bought a building. This is we talk about value added real estate. Comes into a neighborhood. Everyone's paying $800 of rent. You can't really raise the rent to $800. But he goes in the building. The expense for the utilities costs building $10,000 a year. He goes in there and he private meters every single. So each tenant gets their own bill going forward, and then the expense just took away $10,000 of expenses on the building. If the building was in a bad neighborhood and it would trade at a 10 cap, which is the higher the cap rate, which means the worst of it. Someone's willing. It has to be a bad neighbor. They're willing. They need to make such a high return. That means you just added $100,000 in value to this building. So you could have a building that just by putting a little bit of money into it, private metering it, you go snap your finger and you just added $100,000 in value to the building or $150,000 in value to the building. The problem, though, is this was a big debate at that time. How many of those tenants are paying $800 at market because no one else is private metering? So when they got that realized they're getting a bill, they might pick up and leave. So if it's going to cost the average tenant $50 a month for utilities, are your tenants going to leave because you're making them pay their own utilities? or no, are they going to pay in effect at 850? But basically what you're doing is you're raising the rent without, it's like the airlines, you're raising without telling you're charging for luggage. So your price is saying 800 as every other apartment in the neighborhood, but you have another expense that others don't have. So they sometimes when you show the bank a projection what you plan to do, they give you half credit. Because they think some tenants will leave, some tenants will argue, some tenants will meet you in the middle, they'll want to pay $775 rent to absorb it. But these are where creative people did different things over time. Water, sewer, payroll, and that's how much money is it the payroll to pay for the supers and the maintenance people on the property. The management fee is the 5% management fee, which is a typical 5% management fee. It's put in for the person buying the property. Most banks are going to underwrite and assume he took a 5% management fee, which is the collections of the income to oversee this whole process. Maintenance and repairs. Sometimes typically goes by lingo as repairs and maintenance, but however you want to put it, R&M, everyone has different ways they write it out. But on the maintenance and repairs is that most people have a number that they just say, a building like this in this neighborhood, on an average year, $250 a unit, $500 a unit. So you have a 10-unit building, I don't care what last year spent, okay? 10-unit building is going to cost you $5,000 a year. That's what it costs, the added line item, the miscellaneous line item there. And others go with the worst approach. They have the number from the appraiser, which should be 500 units. But if you're actually spending $8,000 a year, they're not going to agree with the 500 number. It's the other way around usually. Someone shows, no, I could run my building so cheap. I only spend $300 in repairs and maintenance a year. They're going to come back and say, listen here, you have $300 in repairs and maintenance a year. You're running it too thin. You should really be putting more back into the building. So therefore, we're going to underwrite it as if it costs of $500. So even though you don't have an actual expense of $500 a door, only spending $300, we're lending you money, selling the building again to go with the gap concept, to be able to compare it. I don't want to have someone who's amazing at running a building, and maybe he's extra cheap in running his building. He's doing it wrong. And if his building's not worth more, it's more neglected of a building. So to keep it even, that's where underwriting could kick in. CAM is the acronym for Common Area Maintenance. This applies primarily on office buildings and shopping centers. Where in an office building, when you rent an apartment, you don't focus on the square footage. You just walk in, my apartment, 2-bedroom, I pay a certain amount a month. When you rent office space, like this building that we're in, so if I have 10,000 square feet, I pay for 10,000 square feet of office space. However, there's common area expenses that I might have to pay to reimburse the landlord for common area, to pay for the lights outside the parking lot, the elevator, the stuff that's in the hallway you saw before you got into my room. That's the common area maintenance. So that might be that's an expense that the landlord has to run the building. But sometimes the landlord is able to get a reimbursement. That's the example we set on tax and other reimbursements. Sometimes they could also get the CAM as a reimbursement. But an owner typically has an expense on an office building and a shopping center. There's a lot of common area maintenance that he has, and that comes up here. If this was an apartment building, another word for common area maintenance would be snow removal. Those are line items that could be on an actual apartment building. Security, if it's relevant, and replacement reserves. Replacement reserves is that there's always a certain amount of things that break within the building. A refrigerator, just as an example. So how many times replacements are you putting away to fix certain things? It could be and I don't think a refrigerator is probably more in repairs and maintenance. But if you have to do over a roof, replacement reserves, and you have to do a roof in 20 years from now, and the roof's going to cost, let's say a roof's going to cost $20,000 using a low number, then you have to put away every year $1,000 a year replacement reserve. So when the 20 years comes up, you have enough money sitting in the bank for that. So these are the similar types of line items that could exist. Not every building has all these line items. Sometimes the tenants pay it. Sometimes it's a small building, doesn't have it. But this is like the most broadest common term on the broad end. Okay. To reiterate the disclaimer, okay, I had a disclaimer before from a legal standpoint. Now I'm not giving it to you as a legal standpoint. Now I'm giving it to you as a practical standpoint. Since you're taking this course now, I want to make certain parts of this course easier for later on to reflect back at these points. So I'm using fake numbers on these deals. I worked out numbers. They're in a relative level of a ballpark. But you can't use this as your gauge. Like, oh, I saw a building here, and it showed $7,500 and $10 per unit and per month, oh, that's the rate. Don't use this in your assumptions when you're buying real estate either. It's purpose for illustration purposes only. So it's not a legal statement I'm making now. But don't like say, oh, this is my new Bible. I'm going to take these 2 pages, and when I buy real estate, I'm going to compare it. It has nothing to do with the values of real estate, the expenses, or anything like that. This is how a typical apartment building gets sent out to a bank. Pages 6 and pages 7. We have pages 8 that go with it as well, but for the most part, we focus on page 6 and page 7. So the same way when you're buying a piece of real estate, you'll get the same information sent to you. Probably not as nice, probably not with all the underwriting in there, because they're looking to show you a better building with less expenses. My relationship with the banks we have is a trust relationship. I'm not going to waste their time. If I know that every single bank is going to put a 5% vacancy in, I don't send the deal without a 5% vacancy. If I know banks want to put it in management, I don't waste my time. I'm not putting it in management. So I underwrite it. So a bank knows when he gets information from Eastern, they could look at it, they could trust it, they give a quote based on it. No one's getting embarrassed later. If there's a mistake later, it's either it was an honest mistake that was done, or we're on the same page, we know there might be a wiggle room. Other companies, when they send information, and they know they better start from scratch and look at everything with someone trying to get them. When you're buying real estate, the whole game is about getting you, because every buyer may have a little different tweak in how they look at things. So a seller will put his best foot forward. He'll actually put his bare minimum expenses. No thresholds, no minimums, nothing. And he'll start that way. And hopefully, not so much if he catches you, but if he finds someone who has a view similar to this and buys it, he benefited from it. So, but what I was pointing out to you before, if you look at the line item net operating income, $72,967, the last line before the box at the bottom on page 6, that's that example that I was telling you before. When you're looking to buy a piece of real estate, the first thing you want to look at is that number. This building is throwing off $72,000, and you look at the page, how much looking to sell the building for. So you know, if they're buying it, and you can use the calculator there, if you're buying the building for $1 million, you get 75%, and your NOI is $72,000, what is your cash and cash going to work for? If it hits, you look at the building. If it doesn't hit, doesn't make sense, you rip up this paper and you work to your next purchase. Going with the assumption, let's say it makes sense there. Most people start from the top down. I'm telling you want to start from the bottom up. Because then you only make money if you close. So go to the end of the movie first. What's the NOI? The NOI works with the cash on cash. Now let's go up. It shows me $72,000. So you want to focus on here, if you're focusing on buying this building, is you look at the line right above that. Total expenses is $132,000. $57.49 comes out per unit. This is a 23-unit building. So it comes out that it works out that the expenses on this building are $5,700 per unit. If you were buying a building, if you look at the top left corner of this page, this is a building in the Bronx, New York. If you were buying this building, you must be buying a building in the Bronx because you have a guru that knows the Bronx. You should be asking the guru who knows the Bronx and say, I am buying a building. How much is it? How many thousands of dollars per unit? If the person tells you the bottom line costs $6,000 a unit, you got to take an extra $251 times 23. So added that as an expense, and you have less income. You have less NOI when it's all said and done. If the person says it only costs $5,500, then you know, hey, it's possible it's going to get better. By the time you finish, it'll never get better, but you can have an assumption it could potentially get better. It pays to work this deal. You're always taking the worst case of both. So if someone tells you it could cost $1 and someone else costs you 90 cents, use the dollar. You're always taking the worst scenario of everything. Once you get past these two numbers, then you have the expenses covered. Now you want to be able to focus on the income. On the income, you do the same concept. Going out to the top, which is total income, $216,000, works out to an average rent of $9,300 a year per unit. You have the same guru. What are the rents in this neighborhood? If the average rents are $10,000, continue. That means you have some buffer in there to move up. If the average rents in the building in this market is $9,000, you're wasting your time. You're over market. Something's wrong. You can't go up. So even if you want to say the building might work for you, but just know you have no upside. So you have no wiggle room when you're starting. So if you start with your NOI, you start with your total expenses and your income, and that makes sense, now it pays to go line by line by line by line by line to figure it out. So the first line by line, now you start going in the normal order because you know the end of the movie could be right. You want to get all the details along the process. So you start with the income. So the income is 216,000. If you look at page 7, page 7 is the breakdown where the income came from. So if you look at page 7, this is where you do a lot of detective work, and you're supposed to flag all the things that are potential questions to you. So if you look at it, it's simply, it puts a tenant name, it puts the apartment number, how many bedrooms. Now in different markets, they focus on how many rooms, how many bedrooms, square footage, they do different things. Let's assume here they're focusing on bedrooms. Monthly rent, annual rent, lease end date. Now, there are people who all they do is rent apartments. So if you were doing your due diligence yourself, you could pick up the phone to an apartment renter company. Says, by the way, how much is a one-bedroom apartment on this neighborhood? There's websites that have all these things. But how much is it? The guy says a new apartment, a one-bedroom, is going for $700. I have a problem with this building. I'm getting $730. It's a problem. He says new one-bedrooms are going for $800. It means I have upside over here. But one of the things you'd want to focus on, when was the last lease signed? So in this paper here, it doesn't show the lease start dates. So there's nothing wrong. You call up the broker and you say, can I see the lease start dates? Usually it's 1 or 2 years renewals that are on these buildings. So if you know you have a lease that's ending in 2018, you could find out, oh, my lease is 2 years? I know it's not in 2016. You want to find what was the most recent lease that was signed, because that's the best indication what this building is collecting. So when I meet an owner says, oh, you know what the rent's on this building are? It's below rent, below market. $730? Really, the market's $900. It's funny. Last week, you rented an apartment for $730. So how you telling me it's $900? Why do you rent for $730? You actually ask these questions. What you're really supposed to do, the detective work is, you actually pick up the phone to this building and say, I'm looking to rent an apartment. What are your rents? How are you telling me the market's $800 and you're just renting right now on the phone $775? That's where the due diligence gets done. This is where you want to spend a lot of your time, because it's the income. You want to spend it on the expenses also. You want to look at this page and make sure that everything makes sense, everything is reconciled, that it all adds up to you. But as you go down the whole list, you want to start asking questions. Why did you get this apartment more, this apartment less? And ask the questions so it makes sense to you. The more due diligence you do, the better informed, the better information you have to go ahead and be able to move forward. This just tells you the whole rent roll, $18,000 a month, times 12 is $216,000. Now, you go back to the first page. And from here, you have the income that's covered. Now, on the vacancy, I actually broke it out so you could to illustrate a point. Usually, it's a tap of 5% vacancy. Now, vacancy, many people don't fully understand what a vacancy is. It's really vacancy and loss, and collection loss. And someone assumes if I have $1 million in income in a building, the odds are over the course of a year I lost 5%. So my vacancy factor, even if I have everything's rented, just in the time sometimes a unit becomes vacant during the course of a year. It takes a week. I lose a week. Add up all those weeks, it could be 5% of the income. But the way it works is that a bank says you have to have 5% minimum vacancy. So you first, if you looked at the rent roll page, if you noticed on the vacant, there was a line that said vacancy, and I applied a rent. The reason why I applied the rent is because in order to underwrite a deal perfectly, you have to first put in all the potential rents. That's why if you look on this page 6, it says gross potential income is $216,000, not actual potential actual income. If everything as rented as is, plus the vacancies rented at market, okay? Potential is not to take the rents that are $900, $700 and say, oh, the market's $800, so potential is $800. No, take actual leases and apply the market rent for the vacancies. That's my gross potential rent. Now I have to take a vacancy. There are 2 types of vacancies you have in a building. There's the actual vacancy, which in this case is $9,000, which is the physical vacancy, $9,420. However, that only represents 4.36%, math. But a bank says we take a minimum vacancy of 5%. So underwriting adjustment, $1,380, which brings you to 0.64, total vacancy of $10,800. That's how it works. So there are people out there, you could play out different games, different numbers. Sometimes it's better for you if the actual potential rents are lower or higher based on what's actual vacancy or not. But this is illustrating a point to you about actuality. 99% of the deals you'll see have gross potential rent and put a 5% vacancy, which is gets you to the same number. I'm illustrating this point so you understand there's really a science to it. And in the heyday of a market, in a rising rental rate of market, it used to be the fights with the banks were the opposite. Why are you giving me a 5% vacancy? I have a negative vacancy. The minute this tenant leaves, even if I lose 2 weeks, they'll pay me $700, the market $1,600. So I don't have a vacancy. I wish they leave. So in certain times, that's where the crash in 2007, 2008 came in. Is to what extent are they going to buy the potential? Okay, for this building, I'm not going to count any vacancy. What happens if you didn't vacate any units? What happens if the rents didn't go up the same way you thought? You had a collection. That's where some of the issues came in, but that's where a fight comes in. Today, they might have when you hear the word, much tougher underwriting, yeah. No matter what, you have a 5% vacancy. Okay? You might get certain banks to go to 4 in certain areas, but for the most part, whatever it is, that's the number. As you go further down, so now you have effective gross income. Based on my underwriting income on this building is $205,000. I took the potential, if everything was rented up, I took away the vacancy factor, and we're left with 205. The rest of the line items are pretty much actual. These are the expenses they have, with one other line item that's a minimum number. The minimum number is management. Because if I buy a building myself and I run it, do I take a management fee for myself? No. I don't have a management fee. But a bank says, if I bought the building, if I foreclosed as the bank and I took over, I'm going to have to hire a third-party manager. So I have to compare apples to apples. This building was being managed by somebody. So you're not taking a management, fine. But for underwriting purposes, I have to assume that there's a 5% management that's in place. Sometimes on a larger building, you could prove that the management is 4%. You could prove it, for the most part, 5%. 5% is the number across the board. And I gotta tell someone, you want to be conservative? Make sure when you buy a building, it has the higher of all the possible numbers. If it still works that way, you'll know when you get a surprise, you'll get an offset of things you know you had buffers built in to offset those surprises. If you go and you underwrite down to the bare minimum, and then you get a hiccup somewhere else, you're up the creek. It doesn't work for you at that point anymore. So that's how this that's where the management works for. So you have the line item requests. If at this point the deal makes sense to buy, to you, the next step is to ask for the historical. You gave me the numbers now in 2017 now. What were the actual full 12-month numbers? 2016, 2015, 2014. Go back 2 or 3 years. And you want to compare and say, oh, security was $7,500, you told me. The last year was $8,000. The year before was $8,500. The year before it was $9,000. So sometimes you could say, oh, I like the trend. I agree. It's on its way down. It's $7,500. Somebody said, no. You never got it better than $8,000. I'm changing this from $7,500 to $8,000. Now, I don't have $72,000 in NOI. It's $900. I have $72,400 NOI. Because I just lost $500 there. You go line by line and you fight it out. Again, it's a lot of his opinion. It's convincing a bank of certain things. So there's certain trends happening in the real estate market. You could buy into certain trends. Certain trends are not happening. You could buy out of certain trends. Different buyers have different risk appetites. You have to realize when it comes to a buyer of real estate, he knows he's taking risk. He may lose his money. But on the other hand, he can double or triple his money. A bank doesn't have that luxury. A bank is either going to lose their money or make the lousy 3, 4, 5% interest rate you're paying them a year. That's it. You find the building's a grand slam. You buy it for $1 million worth $20 million in a few years. You go to the bank, thank you very much. Here's your loan, here's it back. They have no upside. So therefore, the guy goes, you want to buy it with those assumptions? Great. But I'm only lending you based on these numbers. In New York City today, even though banks lend 75% leverage or 80% leverage, in New York City, they're lending 60%. They're lending you 75% of the appraised value based on their underwriting cash flow. And the fact you bought a building at a 4 cap, they can't help you because you don't have enough cash flow. Your interest rate to the bank is 4%. So you can the only way to borrow enough money is put down half in cash sometimes. So does everyone lend 75% to the appraised value? Yes, but it's the underwriting appraised value of cash flow. And that's how it works in the underwriting due diligence. So the buyer comes in for a lot more money to go ahead and buy the building because for him, he could afford to make that mistake and make that difference. I want to stop here. And I'll continue as the next level gets much more in detail and it takes a whole longer part. This is the baseline, the basic of every single setup, and then we'll grow it from here. Thank you.